All right. Well, thanks, Rich. As Rich said, my name is Mark Dikeman, the Executive Director with KFMA. I'll let Kellen kind of introduce herself, but our purpose here today is just kind of give you an overview of our results of the summary results from 2023. Kellen.
Of course. Well, good afternoon, everybody. I am Kellen Liebsch. I serve as the Associate Director of KFMA. And as Mark said, we are excited to share the summary findings kind of for the state as a whole. And we'll be happy to answer questions at the end, as it's one of our primary purposes to share and get that information disseminated across the state. So happy to answer any questions at the end of our primary research purpose.
And I'll mention when we start here that the data we have in here is somewhat limited compared to what we do actually collect and publish. There's a lot more information available at agmanager.info/KFMA. There's association. The Farm Management Association has 6 different associations. Each of those publishes some extensive data for their association, their summary results, as well as some data at the state level, all there on agmanager.info. So we'll start just kind of giving an overview or roadmap of where we'll head today. We'll start a little bit by giving you, for those who may not be familiar with KFMA, I do see a lot of familiar names on here, so I know some of you know what we do, but just kind of give an overview of KFMA, of the KFMA program, what we do. We'll spend some time talking about net farm income for 23 and some trends associated with farm income. We'll spend a couple minutes talking about government payments and crop insurance and the importance of those to net farm income for throughout the state, especially in 23, quite important. We'll spend some time looking at the balance sheet, what changed, what that looks like, some solvency and liquidity trends, which are very interesting, especially looking back for 40 years or so, almost 50 years. A few items of note, and then Kellen is going to pull out our crystal ball and give you some projections or things to look that we're kind of looking at in 2024.
You know better than that, Mark. It's a magic 8 ball, not a crystal ball.
Sorry, magic 8 ball.
Magic 8 ball.
And actually, Greg Ivandahl, who's I think is on in a couple weeks here, is going to give a similar webinar to this with his projections for income for 24. Greg has quite a model that has been pretty accurate in projecting net farm income throughout or projecting upcoming net farm income. So his webinar will be coming up here in a couple of weeks. So let's start with just kind of an overview of KFMA. We'll go back one slide here. You can see the 6 different farm management associations in the map. We have 11 offices scattered throughout the state, and there are 24 extension ag economists who all work one-on-one with producers in a variety of areas. One of the key areas of focus is assistance with accounting and record keeping. Where we work with them to create very detailed records. From those records and inventory information, we can create a very detailed accrual whole farm analysis and also look at enterprise analysis for the various crops or livestock enterprises. We take that whole farm data and some of the enterprise data and compare to other farms. So some financial benchmarking that we can compare to similar types of operations, or in terms of farm type, similar size in terms of acres or crop value, gross crop value, value farm production. We can look at we can benchmark those farms in a number of different ways. And another very important piece that we spend quite a bit of time on is working with farms to plan at the end of the year for income taxes, to target a taxable income, and based on what's happened so far throughout the year, what we project is coming up. We spend a lot of time trying to predict where the year will end. A note here about accrual farm income, and we want to emphasize that all of the numbers that you're gonna see today are accrual calculations. The big there's certainly a difference between cash reporting that you might be shown on a tax return, income tax return, versus an accrual calculation. And we do our best to make sure that we're standardizing things to be able to compare apples to apples across farms. You know, as the slide says, cash data or cash reporting is extremely important for income taxes, and that's not something that we dismiss. But it can be very misleading when you're trying to compare operations, because there's so much that can be done with prepays, with inventory not being accounted for on the cash return or on the tax return. There's just a lot of little nuances when it comes to comparing those. So we work very hard to get to an accrual number. So use some caution if you're comparing your own numbers to what we're reporting here. There is some adjustments that might need to be made. So as an example of those adjustments, we start with cash records, and we make adjustments for inventory of products raised for sale, so grain or calves or whatever. We account for that inventory both beginning and end of the year. Same thing with breeding livestock. We account for it essentially when in our calculations we're forcing a farm to purchase breeding livestock at the beginning of the year and sell that livestock those breeding animals at the end of the year, and that creates that accrual calculation. We're also factoring in accrued income or expenses, prepaid expenses. We're targeting those or adjusting those so those fit in the year that the expense is applied to, not necessarily when the cash transaction occurs. And we utilize a management depreciation rather than tax depreciation. As I mentioned earlier, there's a lot of different things we can do with depreciation for tax purposes. We can accelerate, we can slow things down. Our management depreciation system, it kind of standardizes that and eliminates the acceleration of depreciation. I'll note here there's a link at the bottom there for the financial benchmarking tool. This is something that Robin Reed here in the department has put together the last several years. We don't have it updated for 23 yet. We'll work on that here soon. But it does allow you to input some of your own numbers and makes the adjustments to be able to compare more closely to KFMA data. So let's look at an example real quick of an accrual calculation. Just a really basic example. We're going to look at corn. At the beginning, in this example, at the beginning of the year, there was 30,000 bushels of corn on hand at the beginning of 23. And at the time, it was valued at $6.75 a bushel. So that gives us a total of $202,500 worth of value. For whatever reason, This producer held on to that corn and didn't sell it until May. And as you know, in 23, there was a decline in prices. We'll discuss that a little more here in a bit. But by the time that grain was actually sold, it was worth $5.30 a bushel for a total of 159,000. In 23, they raised another 23,000 bushels, didn't sell any of it, and we valued that at the end of the year at $4.50 a bushel. So the value on 12/31 would have been $103,500. So if we go through the accrual calculation, well, with the cash calculation, what would be reported on their income tax return is only the corn that was sold during the year, the cash transaction of 159,000. But the accrual calculation, we're going to take that ending inventory, the 103.5. We're going to add in their cash sales of 159,000, but we're going to subtract off the value of that grain at the beginning of the year, that 202.5. And we subtract that off because we counted that as income in the prior year. So really what we're accounting for is the change in value plus what is produced during the year, the value of what's produced during the year. So accrual income in this case is only 60,000, quite a bit of difference between the 159 that would show up on the tax return. So again, just kind of emphasizes the importance of an accrual calculation versus cash basis.
And it also becomes more and more important as grain prices change throughout the year, which I know Mark is going to harken back to again in a moment. So
yeah, that is very, very true. And I'll talk about that right here. So what's just kind of an overview of what happened in 23. At least according to KFMA data, drought was a big story. Continued drought. Much of the western part of the state saw a pretty severe drought in 22. That carried over for the rest of the state pretty much in 23. You can see the University of Nebraska drought monitor map here for Kansas. I just picked August 1st, but quite a bit of red area throughout the state, which really leads us to reduced yields, just lower overall production throughout the state. The next kind of highlight is falling grain prices that we discussed. This impacts farms in two different ways. The first is I kind of alluded to in my example, that grain that was carried from 22 into 23, if it was not pre-priced, more than likely there was a decline in value there. So there was kind of a hit because of those falling grain prices. And then again, with 23 production was lower and grain was worth less than what it was compared in the previous year. So our gross crop value per acre took a pretty big hit in 23 as well. I mentioned before that crop insurance and government payments are pretty important. They accounted for a very large portion of net farm income this year. We'll talk about that in a minute. And kind of a highlight for the year, a positive note is the increase in cattle prices. Beef production, in particular, beef feeding enterprises, backgrounding enterprises did very, very well in 23. So let's look at the overall numbers, numbers for the state. Value of livestock produced about 188,000. And I'll note that when we refer to value of livestock or value of farm production, that is one way of measuring gross income or gross receipts. This is an accrual calculation from the start. So that 188,000 is the the value produced. That is not gross receipts from livestock. I think that's important to note. That is the added value. You think of it as someone who buys a calf for $1,000 and sells it down the road for $1,100. They've produced $100 of value for that calf, and that is what that value of livestock produced number is representing. Total value produced, so this is going to include that value of livestock production, crop insurance, government payments, grain sales, miscellaneous income. Total value produced was $831,000 for the year. Total operating expenses, so seed, chemical, fertilizer, labor, fuel, repairs, whatnot. A total of about almost $617,000. Interest expense of almost $31,000, $30,875. A depreciation expense of almost $86,000. Again, this is a management depreciation. This is not tax basis depreciation. Our attempt here is to more closely reflect reality. We don't quite get there with our depreciation expense, especially the last few years where maybe there's been an appreciation in some machinery instead of depreciation. So that gets us to total farm expenses of $733,500 for a net accrual farm income of $98,299. The average farm for our summary purposes, average farm had a total of 2,316 acres. That's going to include fallow, that's crop acres, pasture. That's all acres on the farm. Of those, about 1,634 crop acres, and I will note that we include hay acres as a crop acre for this purpose. Total harvested acres of about 1,739. So the fact that that is higher than total crop acres indicate there's quite a bit of double crop, and we know that to be true in certain parts of the state. Quite a bit of double crop, either beans or milo after wheat. Average number of workers, 1.58. So number of workers would include the owners and hired labor. Number of operators is of 0.95 is the number of business owners. So roughly 6/10 of a full-time equivalent is the average hired labor throughout the state. And you can see the yields here. Dryland yields due to drought took a hit compared to previous years. About 106 for corn, 25, almost 26 for soybeans. Both of those down about 20 bushels from the previous 5-year average. Milo, grain sorghum, about 54, and wheat of about not quite 42 bushels per acre. So again, drought had a significant impact on production throughout the state. Take a look real quick at the 5-year history of net farm income, and it's a very distinct peak there in 2021. Our average net farm income in 21 was 319,000. 22 dropped down to almost 178,000, and about 98,000 in 23. That decrease, or that change from 22 to 23 was almost a 45% decrease, and about a 69% decrease from 2 years ago, from 2021. Now that's a little deceptive. 21 was a fantastic year. In fact, when we adjust for inflation, which we'll look at later, it is the highest year we've had since early 1970s when our electronic data bank was created. You can see here the 5-year trend for the state again and for each association. All of the associations followed the trend of the state with an increase in 20 over 19, a dramatic increase in 21, and then falling from there. The incomes throughout the state range from about 62, almost 63,000 in South Central to about 127,000 in the Northwest Association. And it's not uncommon for the Northwest Association to be our highest or most profitable association, and that was true for 23 as well, just greatly reduced numbers compared to the previous 4 years. So I mentioned the history back to the early 1970s. I think it's very interesting to look at net farm income on an by adjusting for inflation. So all of the incomes that you see here are based on 2023 dollars, adjusted with the producer price index, going back to 1970. I mentioned 1973, just a shade over 325,000. That had a significant impact on that average for the 1970s. Ended up about almost 125,000. But a big drop in the 80s. Some very, very poor years there for a number of reasons, but average of about 45,000, jumped up to about 78,000 in the 90s. The turn of the century, a few difficult, tough years in the early 2000s, kind of offset by some very profitable years to end in 2007, 8, and 9. So an average in the 2000s of about 104,000 to about 130, almost 140,000 in the 2010s. You can see 21 stands out there very significantly. And 23 looks like a small number compared to the previous year. It was a big drop when we adjust for inflation. Let's switch gears a little bit and look at the influence of crop insurance and government payments. Net crop insurance, and I want to emphasize that this is net. So this is crop insurance proceeds minus premiums paid. The net of that was about, for the state, about $82,600. That works out to be about 84% of our net farm income of 98,000. Add into that government payments of about 33,800. That's an additional 34% of our net farm income. So when we combine the two of them together, that net crop insurance and government payments totals about 106, almost 116.5, which works out to be about 118% of net farm income. Because that is a number greater than 100, if we back out crop insurance and government payments out of our net farm income, or net farm income without crop insurance and government payments would be a negative 18,149. So again, this just kind of emphasizes the importance, especially in low income years, in drought years like we saw in 23. There's definitely a need for some sort of support in whether that's government payments or crop insurance. Those have made a big difference in poor income years. Look at each association. So the purple bar is accrual, their accrual net farm income, and the red bar is their net farm income less government payments and crop insurance. So the western 2/3 of the state really relied very heavily on crop insurance and government payments. The Northwest Association went from about 127,000 down to roughly negative 75,000 without government payments and crop insurance. The Southwest Association net farm income was about 102,000, and without crop insurance and government payments, they would have been a negative 100,000. So very significant impact for both of those states, or both of those associations. The North Central and South Central Association, not quite as big of an impact, but still very significant. In the Northeast and the Southeast Association, where we see more rain and saw more rain, government payments and crop insurance didn't carry quite the load, but still had a big influence. And as I mentioned, for the state, without government payments and crop insurance, that a net farm income of negative 108 or negative 18,000 roughly.
And I might point out that those government payments are both crop government payments and livestock government payments. So they're picking up your ARC, PLC. They're also picking up your ERP and your PARP. So disaster payments, anything across the board, they're picking up all of those.
That's correct. Thanks, Kellen. So going back, looking from 1990 on, I wanted to look at the impact of net farm income, like we just did in the previous slide. Look at the trend in net farm income without government payments and crop insurance. And I'll point out here that prior to 1993, our data did not separate crop insurance proceeds from other income. So we started doing that in 1993. That's why the black line, the trend there shows begins in 93. But you can see a number of years throughout, especially in the late 90s, early 2000s, where net farm income without government payments and crop insurance was negative. A period of 6 years there where we would have had negative incomes without those two. Again in 2015, negative, and again in 2023, a negative net farm income without government payments and crop insurance. We'll switch here to talk a little bit about the balance sheet some. And for the farms that were in the KFMA summary, we'll look at ending numbers in particular. End of the year, average total liabilities of about 752,000, about a $58,000 increase for those farms from the beginning of the year. Total assets total assets into the year, about 3,474,000. That's an increase of about 111,000 from beginning of the year. And I'll note that when we the values that we put or that we include for land in total assets, we don't adjust those values unless land is bought or sold during the year. We don't adjust those values for a 5-year time period. So 2020 would have been the last time we kind of fixed those values or adjusted those values. And the purpose of that is to give an indication of earned net worth change. So excuse me, we're increases in assets and increases in net worth are due to performance of the farm, not appreciation in values of assets like land. So the net result of the increase in liabilities and the increase in assets is that net worth increased by about $53,000. So even in a tough year, still saw some increase in net worth, which is a very positive sign. Debt to asset ratio increased slightly, up to 0.217. From a financial or a farm benchmarking standpoint, that is a very healthy level. I think once we get to the 0.3 range is kind of the upper end of what we like to look at. So still very healthy, although there was an increase. The current ratio, so this is current assets divided by current liabilities, that decreased to 2.91. So the higher that number, the better, essentially. So we did see some erosion in that current ratio, but still very healthy position at 2.91. One of the measures that we like to look at for when it comes to liquidity is a ratio of working capital over the total of operating expense plus interest. And to us, this kind of gives an indication of how much of if expenses in the upcoming year are similar to what they were in the previous year, how much of the year can be covered by operating assets, by working capital. And we define working capital as current assets minus current liabilities. So sell everything January 1, sell the current assets January 1, pay off all your current the debt or liabilities due within the next 12 months. What's left over is working capital. So in this case, about 90% of the year's expenses, or the operating expenses plus interest, are covered or were covered by working capital on hand at the end of the year. Very, very healthy in that case. It was a drop from 22, where we were at about 96%, but still quite healthy. We'll look at some trends in solvency. Going back to 1973, so the gray bars are ending total debt, and you can see since 2020, we've seen a pretty sharp decline in total debt at the end of the year. However, that ticked back up in 23. As I mentioned, about 752,000, up from 600 and some thousand at the end of 22. The purple line with circles on it is the debt to asset ratio. And since roughly mid 80s, there's been a very noticeable trend downward in debt to asset ratio. I would speculate that we learned quite a bit from the 80s and have maintained healthier balance sheets and focused on that debt to asset ratio since then. The last thing I'll point out here is the effective interest rate. That's the purple line at the bottom of the graph with the triangles. Effective interest rate in 82 was the peak. Looks like about 12%. And our effective interest rate we calculate by taking interest expense and dividing that by average total debt for the year. So pretty simple calculation. In 2023, that number worked out to be 4.3%. So from a an interest rate standpoint, still fairly low, especially relative to the interest rate changes we've seen the last year or so. But not a we're still in a healthy range, I think, for 23. It did tick up in 23 compared to the last couple of years. Let's take a look now at some liquidity trends. So in this case, we'll look at working capital. Working capital has definitely, well, from the late 70s through early 2000s, not a lot of change in working capital. And I should point out that these are inflation adjusted numbers, inflation adjusted to $23. But since the late 2000s, been a run up in working capital available, a dip there in 2015 with the rougher year of 2015. Took a few years to recover, and working capital increased there very dramatically in 21 with the very profitable year there, and taken a little bit of a drop since then. The working capital over operating expense plus interest calculation I mentioned earlier is also graphed there. That has bounced around pretty significantly, but does somewhat follow the trend of working capital over time. Let's look at some per acre numbers. So we're going to look first at gross crop value per acre. So this is the value of crops produced, including hay, and also government payments and crop insurance. The crop share of those are both included in that gross crop value. So average across the state in 2019, gross crop value was under $400 per acre at 386, and that reached its peak in 21 with good yields and good prices of $540 an acre, and in 23 that dropped down to $470 an acre. Again, keep in mind that that does include hay acres in there, so that can kind of drag that number down. But average across the state of $470 of gross value per crop acre in 23. Crop insurance, or sorry, crop production costs, so seed, chemical, fertilizer, cash rent, that has gone from about $250 or $258 an acre in 2019 to almost $374 an acre in 23. So significant climb there. Machinery investments follows the same trend, about an average of about $250 an acre in 2019 up to about $350. So $100 increase in machinery investment in the last 5 years. Crop machinery costs, so that's so I'll clarify that investment is the value of the crops crop portion of value of all machinery equipment, whereas the crop machinery cost covers fuel, repairs, depreciation expense, and whatnot related to the crop machinery. So that's gone from $91 up to $133. The increases are quite alarming, and I don't see that. I'm not sure if we should expect that trend to reverse anytime soon. Look really quickly at farm or net income per operator by different farm types. And again, this is per operator. Some of the cow herds are smaller. The idea behind the per operator calculation is to to kind of take scale out of the equation. So so larger farms on a per operator basis are going to be scaled backwards to be able to more easily compare across enterprise types. I've highlighted in bold the cow herd or any farm type that that has a significant focus on beef production, whether that's cows, whether that's backgrounding, or some other type of feeding enterprise. If beef was involved in 23, it did well from a farm type standpoint. I'll point out cow herds on a per operator basis. The previous 4 years were very low, anywhere from $45,000 to $80,000 of net farm income per operator, to a huge jump of $282,000 of net farm income per operator. Looking at enterprise data for cattle enterprises, Kellen went back and looked at things from 2013 to 2023. 2014 was the last year we saw really profitable cattle enterprises. You can see, and this is return over variable cost on a per head basis. That varies quite considerably. So especially with the backgrounding enterprise, a number of years of negative returns over variable cost, and a number of very profitable years on a per head basis. Some other items to note: I mentioned earlier, effective interest rate of about 4.3%. We would very much expect that to increase for 2024. Somewhat interesting this year, the number of farms, almost 50% of farms in the KFMA summary had accrual net farm income of $50,000 or less, including those who had a loss. So quite a number. From a distribution standpoint or percentage standpoint, a very large number of farms at 50,000 or less. When we look at quartiles or distribution of that income of farms, the top quartile had net farm income of about 369,000, and the lowest, the last quartile, the least profitable quartile, had net farm income of negative $93,500 roughly. So a big spread and a wide range in incomes throughout the year. Family living, this was kind of a shocker to all of us. We had expected family living to increase, but this is the first time we've seen family living costs above $120,000 at $123,835. Quite a jump from the previous year, and that's well, we'll talk about the family living costs here in a minute, but the breakdown of that. I guess it's the next slide. So the biggest piece of that family living expense was income and self-employment tax of $33,000. Just general food, household operation of almost $22,000. Recreation about $15,000. Health insurance always been a significant expense for households of about $13,500. Medical expenses about $6,200. Charitable contributions about $5,600, and then about $28,000 of everything else, utilities and education expense, gifts, whatnot. That, looking back over the last 5 years, as I mentioned, that the income and self-employment tax category was the largest in 23. It was also the largest in 22. And there's been a big jump from 21 to 22, and then again to 23 in that income tax total. With our accrual calculations, we often see that the tax impact of that is delayed a year or two. So I think we're seeing the people did a lot of work to manage income in 21, and now they're in 22 and 23 are seeing the results of that. What one of the curious questions I have is the increase that we've seen since 2019, about $30,000 total in net or in family living expense. Is that driven by inflation? We've seen significant inflation in the last few years, or is it driven by profit? Meaning, as farms become more profitable, are they spending more money? They have more money to spend, so they spend more. I don't know that I can answer that question, or will ever have an answer to that, but that's an interesting thought when we look at this increase. And kind of the flip side to that is, will we see lower family living expenses in 24 now that we've had a pretty big decrease in net farm income in 23 relative to the prior couple of years? All right, Kellen, get your magic 8 ball. And
all right. Well, I forgot my actual magic 8 ball today. I should have brought it to work. So as kind of a preface to Dr. Eibendal's presentation in a couple of weeks, we wanted to just put a couple of thoughts in your mind, which are probably already there, but thought we would just share a couple of ideas, our predictions for 24, which a lot of these are already in play. The first one with, will Mother Nature be kind? As Mark showed the drought monitor map for 2023, a picture from August, while the drought monitor has lessened the conditions across the state into 24, there's also wheat producers across the state that their wheat's kind of being spoon-fed at this point. So whether Mother Nature will be kind to get those crops out of the ground and to help those other row crop producers and cattle producers as they're getting forages into 24. So hopefully Mother Nature will be kind to us in the ag industry. The second one is, can crop production make up for the lack of lower farm gate prices? Just a couple short years ago, our farm gate prices were much increased. And even with average production out of the fields, we saw those net farm incomes that were substantially increased. Well, unfortunately, if our crop production can't make up for that decreased price at the farm gate, kind of questionable for whether that crop production can make up for that. We've talked about how cattle producers had a very strong 2023, was very much a shining point, a shining star for a lot of our producers in the KFMA data set. Most of those will still see a favorable year, potentially not as strong as 2023, though, as the literature states. And then probably the last one that I'll point out, USDA ERS very specifically states that government payments are forecasted to not be as strong in 2024 as they were in 2023 across the board. So ARC, PLC, those are obviously lagged, as well as ad hoc and other supplemental disaster assistance programs. There's a lot of literature out there that states those programs will not be paying out as much in 2024. And Mark shared quite a bit of data that without government payments and crop insurance, which we're not talking about the crop insurance piece right here, but without some of those government payments to support the net farm income, a lot of our producers in the database that we work with would not have had even the year that they did with some of that net farm income. So that is my wonky magic 8 ball for 2024.
So I think that kind of wraps up what we wanted to highlight. As I mentioned at the beginning, there's a lot of data that's published at agmanager.info/KFMA. You're welcome to dig into that. If you do have other questions about what we've discussed here or about the KFMA program, my email and Kellen's email are both on the screen here. We're glad to answer questions. Rich, I think we have a few minutes if there are some questions in chat that we can.
Mark, we have one in the chat. Does the 23 crop insurance total income factor in the ECO and SCO payments that have come and will yet come in 2024?
So I'll the shorter answer is no. But the longer answer is if at the way we accrue crop insurance amounts with our data, if we know at the end of the year there are either yield or revenue losses for 23 that have not been paid yet, that don't get paid until 24, we do accrue that income, so we account for those. Those payments might be coming in January, February, very early in the year. However, with ECO and SCO, we just don't have enough information at that point to know what those are going to be. So we have not, well, the payments don't come until May, June timeframe, later in the year. So we just don't have enough information at that point to include those. So no, we don't have ECO or SCO included in those amounts.
Next one, is there an expense line item for crop storage that can be viewed on Ag Manager?
That is a good question. I don't think we have an item specifically for
I'm pretty sure it goes under miscellaneous crop expense.
Yes, it would be under miscellaneous crop expense, which is going to be, the majority of that is going to be storage expense, but we do not have storage broken out separately.
Any other questions? And I have made it possible for you to unmute and ask a question orally if you'd prefer to do that, or you can put it in the chat. Go ahead if you've got something.
That either means we covered everything that someone might have questions on, or we put everybody to sleep, one of the two.
Hey, I'll take either.
Last call. Don't want to shut it off too soon if you've got something, but we won't hang around too long here either. If you do have something, either unmute and talk to us, or else go ahead and type something in the chat.
This is Louise Emke, real quick. We had internet issues, and so I got in here late, and you probably answered this, but what percent of net income did you say was crop insurance, or did you say?
So net crop insurance, that's proceeds minus premiums, was about 82,000. It's about 84% of our net farm income.
Ouch. Well, I was afraid of that, and yeah, I can, yeah.
Pretty significant number.
Yeah, and the part of the state that you're from was pretty much leading the pack in that. So.
Yeah, 84%. Holy, thank you. Well, we have had some rains this week, and it's looking a little better. And the disaster that was coming is better, but there's still the rest of it that's not good. But there is some good stuff.
We like hearing the good stuff.
There is some good stuff, but there's it's not a bin buster, but it's better than it was looking. Put it that way. Yeah. Thank you very much. We appreciate that. I'll look at the recording. I'm sorry about that. Thank you.
Thank you.
Thanks, Louise. We've got a question in the chat. What should we look for in the new farm bill as it relates to government payments and crop insurance?
That is a very, very good question, and one that I am completely, if I attempted to answer, I would be completely out of my wheelhouse. So, I think the big thing there is to get something, to start with, to know what we're looking at.
Mark, I'll just jump in a little bit. I have been reading a little bit. We need Robin Reed or Jenny Ift on this, but what I have been reading is that crop insurance will probably continue pretty much as it has been. There is a possibility of some of the subsidy being cut a little bit, so maybe some more premiums, but pretty much as is. If the ARC and PLC type of payments continue, they probably will continue very much as they have been. Perhaps with raising the reference prices a little bit, although that would raise the cost of it too. So it may be a very similar thing, or they may just cut that and put what there is into crop insurance.
And I see that Dr. Ift is on the call. She's muted though right now. But
if that, hang on.
The person that asked the question is what I can reach out to her, and I can certainly put you guys into contact, and we can get you some additional information from some probably better versed people than us. So we will make sure that happens.
Jenny, I just unmuted you so you could go ahead and talk too. I didn't realize you were on.
I don't know. She might not be available at the moment, but she's too. Oh, she just unmuted.
Oh, sorry. I was distracted. What was the question?
What should we look for in the new farm bill as it relates to government payments and crop insurance?
Oh, I'm not sure we're good. It's a lot of pessimism that we're going to get a new one this year. So I think an extension is more likely, and based on the Senate outline and what we saw come out of the House, there may be a slight to modest increase in reference prices, but nothing drastic, no major changes to programs.
Thanks, Jenny.
We
do have another question in the chat. How is owner equity accounted for in the total income?
So we, from a net farm income standpoint, we do not charge operator labor, or we do have a calculation for unpaid operator labor, but it is not part of that net farm income calculation. So return to equity or operator labor neither one are included in the net farm income calculations. But if you look at any of our summary reports, they are immediately below the net farm income calculation are unpaid operator labor, and an asset charge is basically their an opportunity cost on their investment. So both of those are available, but not included in net farm income.
Jenny just typed in here, I think one big open question is ad hoc payments, ERP, et cetera. If we have bad weather, drought over the summer, will USDA or Congress authorize additional payments? It's an election year also.
I guess I would add to what Jenny said. I would expect to see more ad hoc payments based on revenue in the future, like ERP and PARP, where there's revenue calculations or income calculations that go into that, rather than production or yield or price. It's all based on changes in revenue. I would be prepared for more of those.